Congratulations to you running exercise.
Because times are a bit bad now, so people are looking for a way to save their money. So this is a way of saving their money. But of course, the property agents can find other ways of methods to see how they can get their income. I'm sure they'll come up with something as well. So this is a competitive market, and everyone will be very creative as to how to make sure that their livelihood or their income is not affected in their own way. So I believe that it is a healthy competition, is a healthy option, so where everyone will be having a chance to try their luck in whichever way that they want to.
have to understand that investing is risky, right? But on the other hand, I will say that investing is not like something where you just don't take any risk and you can expect a lot of return. Or investing is definitely not like FD is no risk, right? And then when you start to invest, you have all the risk in the world, and it's like super risky. Investing is not like that. Actually, investing can be manageable in terms of the risk, and you can take different kinds of risk along the way to get different kinds of returns. Low return, modest return, potentially high return. You can enjoy all those returns, right? So you shouldn't think that, oh, if I learn how to invest and I just put my money to work, it will for sure be very risky. And the graph will always look like this, always like COVID period, right? So you shouldn't think like that. Risk can be incremental, risk can be gradual. So like this chart shows, you should expect more returns. Maybe you can hear the thunder in the background, but never mind. With investing, you can expect incremental returns based on the amount of risk you take. So for example, if you have if you're taking no risk and you're investing only in FD, you can expect very little risk, right? Now it's only 1.8, almost 2% returns. And then if you, let's say you buy bonds and you take a bit of credit risk, you can see here some credit risk, meaning the company or the government can go bankrupt, right? It's not likely, right? Let's say a big company like SandW, big company like CIMB, and they go bankrupt, right? It's not likely, but it can happen. So because you take that risk, you can get some return as well. And then with stocks and small caps specifically, it's really all about how well that company does, right? So if a company like Netflix, if I told you about it now, you'll be saying, oh yeah, it's a very big company. But if I told you about it 10 years ago, you'd be like, I haven't heard of it, and I definitely don't think I want to invest in it because it might be risky. What is this video streaming thing? I just open my Astro and that's all I need. But these days, everyone uses Netflix, right? And then Disney Plus is here, and Amazon has its own streaming service, Apple Plus, and all that. So risk is something that you can slowly take on different kinds of risk to expect high returns. And this is important because when I talk about different ETFs, it's not like all the ETFs are the same. And depending on what type of risk you want to take, high risk, low risk, balanced risk, you can choose specific ETFs to suit your needs. Okay, right. So let me first talk about this thing called asset allocation. Whenever I talk about investing, people automatically ask me like, oh, what stock should I buy? And I always like to take a step back and zoom out, because when professionals look at investing, they don't just ask themselves what stock to pick. They first ask themselves, what percentage should I put into what type of asset class so that I can target a specific level of risk? And that exercise is called asset allocation. You will hear me talk about it a lot, right? That is because how much you decide to put towards what type of asset class explains a lot about what return you can get. So that's why in this slide over here, it says 80% of returns focus of today, right? Which means that your decision around asset allocation explains 80% of the returns. So let me go into a little bit more detail, right? So first, you might think, okay, I've never heard of asset allocation before. Normally, it's just what stocks should I pick? Maybe I should pick like 5 of the best stocks I think will go up, or 10 of the best stocks that I think should go up. Okay, and then the second thing is also you have a few choices of how you choose to manage your money, right? Not everyone likes to trade stocks. Not everyone likes to buy property physically, for example. Some people like to buy things in a different way. So if you don't like to buy stocks, you can also buy a fund, right? A fund is usually where someone will manage the money for you, and they will pick what stocks or bonds in order for you to make money, right? So you can do it yourself, or you can send it to an expert, right? So this expert will choose these stocks for you, right? But let's look at how often these professionals beat their benchmarks, okay? Because beating benchmarks is very important. Beating their benchmark is important because if they don't beat their benchmarks, then you are better off not investing with them, or you can just go into a passive fund where it just follows the index. Maybe you've heard of index funds before. That's what they do. They just follow the performance of the index. Then you can see that you can actually get better returns because index funds and passive funds like ETFs don't charge as much fees. If you give your money to an active fund manager who has to pick stocks in order to beat the index, then you have to pay a lot for that service, often 7% per annum, which is really a lot. Okay, so and don't take my word for it, right? So StashAway is a licensed fund manager. We just do things a little bit different. We cut costs because we are digital, and we manage money differently. We use ETFs, so we're not an active fund manager which picks stocks and all that. So don't take my word for it, because you can see here that actually the data shows that a lot of fund managers underperform their benchmarks. Underperforming your benchmark just basically means that if a stock market goes up by 10% a year, it is the fund manager's job to give you 15% or 20%, anything more than 10% to justify their existence. If they give you 5%, 7%, which is under the 10% of the index, then why should you employ them, right? So this data done by S&P data and index collecting service, they show that over a long period of time, 10 to 15 years, 90% or over of fund managers don't beat their benchmark. So they might be able to beat their benchmark in 1 year or 2 years, but in a row. But if you are with someone, you're with a fund manager, you are with them for an extended period of time, right? Let's say 5 or 10 years. Then along the way, if they don't beat their benchmark, why are you paying them so much in fees, right? So that's the whole justification. So you can see here that large cap fund managers in the US don't beat their benchmarks on a long-term basis. Same story with mid-cap fund managers or small-cap fund managers. Doesn't matter what type of fund manager, they largely underperform their benchmarks. So why are we paying them so much to manage our funds? So it's also not a specifically US problem, right? You will see that other areas, other countries around the world also underperform their benchmarks when it comes to active investing. See Europe and Australia or Brazil, even India, which is a slightly less developed market, is an emerging market like Malaysia. It's around 40% of fund managers who don't outperform their benchmark. So let's say you flip a coin, and it's anyone's guess whether you choose a fund manager who will consistently beat the benchmark or not. So you definitely don't want to be in this situation, right? So if you have a chance to invest passively, meaning you can choose an index fund or a passive ETF to form your own portfolios, isn't that better, right? Isn't that better? Because you don't have to pay so much in fees. Okay, so if any part of this is unclear, I'm happy to address it in the Q&A later as well. Okay, so moving on, even the king of investing or the king of active investing himself, Warren Buffett, says that the trick is not to pick the right company. The trick is to buy all the big companies in the S&P 500, meaning the index, and to do it consistently because the index goes up over time and your money compounds on each other. Okay, so I put a picture of the horse down there because picking a stock is like going to the horse racing stadium and then like picking horse number 9, and hope that horse number 9 will win, right? Whereas if you just invest in an index and invest passively, you don't have to hope that your one horse or your one stock will win. Anything can happen to that company, either the management team or the results are not so good because of COVID, or they do something that is not good financially. Maybe they over leverage themselves and are not in a good position. Obviously, it can be good things that happen as well, but you will take that risk if you just pick one company, right? So that's what you're doing if you just pick one stock. Okay, so that's why you can actually manage risk by using exchange traded funds. Right? ETFs are a very good way to not just express your asset allocation or put your asset allocation to work. It's a very good way to manage risk as well. Okay, so as I said before, I want to really hammer home this idea of what asset allocation is, right? So asset allocation is basically, wow, raining very heavy. Asset allocation is basically how much percentage you want to put into what kind of asset classes. Broadly speaking, there are. Wait, I need to close the window.
Sayang your pen.
Okay, I'm back. Okay, can anyone can I just confirm that you guys are still there? Can you hear me? If can, then I'll continue. I can't see your screen, by the way, so I'm assuming that you guys can hear me. If you can't, someone from SPEEDHOME, please shout. Okay, so asset allocation, very, very important concept, because basically it's the decision to on how much percent you want to put towards what asset class. Okay, so there's basically 5 types of different asset classes, not including alternatives, but those asset classes are property, equities, bonds, commodities, and cash, right? So there are 5 main big categories of asset classes. So when you look at this slide, basically your decision on how to invest, a lot of it will hinge on how much percentage you want to put towards what asset class, how much you want to put towards US large caps, how much you want to put towards, let's say, tech sector, how much you want to put towards bonds, how much you want to put towards gold, how much you want to retain in cash, for example. So that will ultimately determine what returns you will get in totality, right? But I will also say that how much you decide to put in what asset class depends on what kind of risk you want to take. If you are almost retiring already, your risk appetite should be very, very low. You shouldn't be taking a lot of risk with your nest egg. And then if you're very young and you're looking to retire in, say, 20 years, you really should be looking at optimizing the amount of risk you can take so that you can actually get a high return in the long run, right? So, okay. So let's see here. Normally, portfolios look like this, right? Portfolios are very, very, portfolios of normal clients that I meet, they look like this. They are not very streamlined, they're very messy, because people basically go through life and they just collect financial instruments. Even when they think they're investing, actually what they're doing is they're buying financial products. Obviously, it's, you want to invest, therefore you buy investment products, right? But actually, that's not the way to think about it, because you should approach it from more of a asset allocation point of view. Meaning, let's say I want more equities in my portfolio, or I want more asset allocation into equities. Then I will go out there and either buy more stocks or get into a unit trust fund or whatever, right? But a lot of the times people don't do that. They just go through life and then they get influenced by salespeople, or they get influenced by something they read or something they learn. Their friends tell them, oh, this stock did very well. I went into the IPO, it did very well, you can go in. And they just go and buy, right? So they're not really thinking about investing in a very in a very methodical way. They are going through investing. They're going through their life by just investing and buying financial products, right? So here are the common kind of financial products that Malaysians have, right? So of course, if you grew up in the late 90s or the early 2000s, you will love property. You probably think that you can be a property tycoon. So there's a lot of investment property money out there. I will say, yeah, of course, you get 1, 2, or 3 investment properties, but 10 or 20, that's a bit crazy, right? There's only so much that you can pay, especially in this kind of situation where tenants come and go and there's competition in terms of a lot of supply of properties. So having too much where you cannot control the debt is not advisable, right? And I meet a lot of people who have a lot in FDs because they don't learn about investing. They think investing is just too risky. They cannot live with the fact that they might lose their capital, so they don't learn about investing. So they have 400, 500,000 just sitting in cash. And then you have people who buy unit trust from their friend, their family member to like so-called support them, but they don't really know what they're being marketed. What I I don't like about unit trust people, especially agents, is that they just sell you what is hot. They don't ask you what you really need for your own goals. They're like, oh, this is very hot. A lot of my clients buy this. It's like, but is it really something I need, right? So that's not the way to sell, right? I'm sure there's some good agents out there, but that's by and large mostly is that they just ping you and they push you to buy something new. And then when good times turn to bad, they ask you to switch. And then when you switch your funds, there's switching costs as well. So the more they service you, the more charges they make from you. Same with ILPs as well, investment linked product. You are buying coverage, but there's a unit trust inside, and you still need to pay all those ridiculous sales charges, and more so they lock you in and all that, right? So this is what I mean. People just go through life buying financial products. They don't understand like big picture, what is asset allocation, what kind of risk I want to take. They just know, oh, tomorrow I want to be rich, right? So that shouldn't be the way to look at things. The right way is to really understand what kind of portfolio do you want. Do you want a portfolio that has all these different asset classes, and what percentage should I put in these different asset classes? That is the right way. So like I said, there's 5 different types of asset classes, and your job as an investor is to determine what percentage of your wealth to put in these 5 different asset classes. So when you go out there and you buy ASB, a fund, or you invest in StashAway, or you buy stocks, or you buy property, you buy REITs, know that all of these assets contribute to your overall asset allocation. So if you're, let's say, middle age, and you are going through life, and you look at your portfolio now and you're like, actually, based on my holdings now, I can afford to take more risk, then you can actively go out there and find the right product for yourself, right? So don't just start like this. You should look at it in a more structured way. Okay, so that's where ETFs come in. You see, this is why I make the point that asset allocation is very, very important, because you need to know what kind of risk you want to take first, and then what kind of products to buy. And ETFs comes under that category of what product to buy. And it's actually a very, very good product because of a variety of reasons, which I'll go into a bit more detail. But just to give everyone the correct definition and all that, ETF stands for Exchange Traded Funds. And basically, it's a fund that is listed on the stock market. And its job is to follow an index or mirror an index. Like if the index goes up 5%, then the ETF will also go up 5%. But it can also copy other things. It can also mirror, let's say, gold, like a commodity, or it can mirror bonds, like treasuries, like US treasuries, or let's say a basket of assets, right? So it is basically just a vehicle that you can buy and sell as liquid as a stock. But within this ETF, that is very, very liquid, contains a lot of other securities, like many, many stocks, many, many bonds, or it represents a commodity, so that you don't have to go through the hassle of like buying all of these securities yourself. Okay, so there are also many types of ETFs out there, like I mentioned. I already talked about the ones where you can just buy an index, right? So let's say you are bullish on US equities, you can just buy an S&P 500 ETF. There's plenty to choose from. Let's say there are ETFs that replicate an industry. Let's say you are very bullish on tech because every day you read about all these tech companies doing well, achieving multi-billion valuation, and you want to buy the ones that are listed. So then you can go out there and buy US tech or China tech ETF that represents that sector. It can also represent a commodity like oil or gold. It can also represent a different type of asset class or a different geography. Let's say you want Asia ETFs, then you can choose that. But then there's also some other more exotic ones, which I'll talk about later, like the inverse one or the actively managed one. So all of those have different pros and cons, and I'll tell you, our position on those, or what we thought when we think about them later on. But essentially, there's so many kinds of ETFs out there for you to choose. Okay, so how we do it, how StashAway does it, is that we first and foremost we have over 30 different asset classes that we have identified, which are important to have in your portfolio, and then we choose the ones which suit this particular economic situation. So for example, now we're in good times, we're not in a recession anymore. You definitely want less bonds and you definitely want more equities, right? What kind of equities? You want more cyclical equities, right? Equities that do well in the good times, where companies are doing well, where countries are open up again, right? So we then choose one ETF to represent each of these asset class. So you can see here, US equities, we have one ETF for that. Asia ex Japan equities, one ETF for that. International corporate bonds, we have one ETF for that. So we have one ETF to represent every single asset class listed here. And the bolder ones are the ones that we feature in our portfolios today. But tomorrow it could change, next year it could change again. But right now, this is what's being featured, the ones which are bolded. Okay, so if you're still kind of confused between what an ETF is, basically it's like a listed unit trust, but instead of dealing with an agent, you can buy and sell like any other stock. And instead of the unit trust fund manager trying to pick the right stocks and be an active fund manager, which has a lot of high fees, you can actually just buy an ETF that replicates the index. Okay. So the benefits of ETFs are these three. It helps you diversify. It's very, very cheap, and it's very, very liquid. So let's say you want to replicate, you want to get exposure to the US, right? And you know that S&P 500 has 500 of the biggest companies listed in the US. So instead of buying 500 odd stocks, you can basically just buy one ETF, and that one ETF will also not only have those 500 stocks, but it will have the 500 stocks in the right weightage. So, for example, if the biggest company is let's say 100 billion, and the second company is 50 billion, it will hold these 500 in the same proportion as how valuable they are in the market. So you don't have to buy all these and then rebalance yourself and keep track of all of it, not to mention all the transaction fees. Okay, so it's actually very easy. And because ETFs are, especially the passive ones, they're very, very, their job is just to follow whatever is in the S&P. There's a lot of automation that goes into the background of just maintaining the ETF. You don't need to like pay someone and an entire department just to like think very carefully about what stocks to buy. So because of that, it's very, very efficient. It's very, very cost efficient, very, very cheap. And because some of these ETFs in the US especially are very, very big, some of them are bigger than the whole Malaysia market, right? So because of that scale, you can also expect that it's very, very cheap to own. Okay, it's also very easy to get in and out, meaning, if you have $10 million, you can just go and buy an ETF and go in and out, and the price will barely move. If let's say you're in Malaysia and you buy a small cap, and the small cap is the market cap is, let's say, 100 million. If you want to sell your 10 million, you will definitely impact the price on the way down, right? Because someone's market will see, oh, someone big selling, then everyone will get out. So if you want to go in and out without causing a fuss, and it's very liquid, you can get all your money back, you can just consider ETFs as well. Okay, so let's look at some of these in a bit more detail. You can see here that there are 3 different ETFs of different flavors. The first one is US equities, second one is US bonds, specifically 20 years, and the third one is gold. And you can see that like I said, this one holds 500 different stocks. The bonds, you can hold 35 different 20-year bonds, right? Because the US government issues treasuries in tranches. It doesn't just go, okay, now here are all the 20-year bonds that will ever exist, right? It will slowly print bonds, and then they will sell to the market. And then this ETF will then buy these different ETFs. This ETF will buy these different bonds and have it inside the ETF. Gold, obviously, there's just one type of gold in the world. So they just represent this gold. They buy physical gold and they put it in a bank vault. And that represents the asset class. So you can see here, when I say cheap, I really mean cheap, right? So normally when you're looking at a fund manager in Malaysia, you have to pay 5% sales charge plus 2% management fee. So 5 plus 2 is 7%. Here you only pay 0.03% every year. Because it's so big, it's a very simple ETF to run and to structure and issue in the first place. It's only 3.03% or 3 basis points. The bonds one, 15 basis points, very, very cheap. Gold, because there's actual physical custody of the gold, is a little bit more expensive, but still overall very cheap, 0.4% only. And you can see the size here is very big, 1.5B, 900 mil, 900 mil. If you want to move in 10 million ringgit, no problem. Okay, so now you probably are thinking, okay, I've understood the benefits of the ETFs. How do I pick them, right? There's so many out there. There's over 5,000 that's listed. Some of them, let's say for one asset class, say US equities, there's multiple issuers. So which one do I choose? How do I choose? Mainly there's four criteria that you should use, and these are criteria that we use to select our ETFs as well. We need it to be simple and easy to understand. We want it to be cheap, we want it to be liquid, and we want the tracking error to be low. I'll talk about the tracking error a little bit later, but basically the simple idea is when we say that the index should follow or mirror the index, like how closely do they manage to track that index? You don't want something that tracks it too loosely and isn't able to follow that asset class very, very closely. So I'll talk about that later on. Okay, so the first quality we advocate is that it should be very simple. So that's why we don't like these 3 types of different ETFs, and I'll explain why. The ideal ETF should just be very simple, very easy to understand, should be plain vanilla, should be passive. The reason why we don't like all this is for the following reasons. So let's say the first one is let's say you read about an ETF that is so-called smart beta, sounds very sophisticated and all that. Maybe they follow specific data to decide what stocks to buy and include in the ETF, and they have different styles. Maybe they have momentum, they have value and all that. So I think this one is basically they're marketing a specific theme. So they're not marketing what risk you are taking, because you actually don't know what risk you are taking, because the people who determine the different data to use to qualify for the ETF will be in charge of how much risk to take. You are not in charge of the risk. So it's not, when you're trying to build a portfolio, you don't want things that don't really fit with each other. Okay, so when you have these different momentum or value ETFs, sometimes they don't fit in nicely with all the other ETFs that you bought, and they can change the logic of these ETFs anytime you want, anytime they want. So you are not really in control, which is why we don't like them. Leverage ETFs, I'm sure you've maybe heard of it before, but essentially the concept is inside the ETF, there's inbuilt leverage, so that you don't need to take share margin financing. You can actually just buy the ETF, and then you pay the price of this ETF. And let's say the stock market goes up 1%, let's say it's a 3 times leverage, then the ETF will go up 3%. If the stock market goes up 2% on a 3 times leverage, then you'll go up 6%. Sounds very nice until you think of the downside. Because let's say you look at this S&P 500, 5 times leverage over here, 5 times leverage. If basically the market falls 20%, 20 times 5 is 100. If it falls 20%, basically you're done. You're at zero already. And in very extreme scenarios, let's say like last year, March and April, where the COVID really hit the US, the markets fell 30-35%, right? So very quickly, you'll be out. And the first rule about investing is you should try and minimize losses as much as possible, because when you are in losses, you need to gain more money to just go back to square one. So if you go down 50%, you need 100% just to be back at square one, which is very difficult to do. It takes time. And then we also don't like inverse ETFs, which basically, if you want to short the market, if you think the market's going to go down, then you buy this, and then this will go in opposite direction. So when the market goes down, this goes up. So I will say that unless you're like a very pro trader, or you want to hedge, no need to buy this, because simply put, markets are up more often than it's down. And the second thing is that when markets go up, there is infinite potential. But when it goes down, you can only gain, let's say you go in at 10%. Let's say you only go in at, when the stock price is 10, and you think it can go down to 0 or a few cents. Basically, it can go down and your upside is only is only 100%. So you cannot earn more because the stock goes to zero, then that's it, right? Or the index goes to zero, which is super unlikely, obviously. So unless you are like this super trader, you're very sophisticated, you're professional, I would say don't use all these 3 ETFs. Okay. Rather, we prefer to use passive ETFs, which are easy to understand. You know what exactly you're getting, and you're in control. Second thing to identify about ETFs is the cost. Okay, so I'll show you a live example later, but the main thing to look at is the expense ratio. Expense ratio is what is the ETF issuer, BlackRock or State Street or Vanguard, what are they charging you to buy this ETF? Okay, so you have the you have the stockbroker which charge you to go in. You have the index, you have the ETF issuer to charge you this expense ratio for using their service. They're giving you a service, right? So it's only fair that they charge something and you pay something, but then you need to know how much you're paying for it. So this is what it is, the expense ratio. Like I showed you just now, IVV, the US one, was only 3 basis points, 0.03%, very, very cheap. Okay, you can add all these up as well, but I think these are more secondary. Let's say the bid-ask spread is how much to buy and sell, what is the gap? Because if let's say it's selling for, let's say let's say the spread is 2%. Sorry, let's say the spread is 2 basis points, right? It's 0.02, 2 basis points, right? It doesn't mean you can definitely get the selling price when you want to go out. The bid-ask spread is the thing that you can actually get the market price for when you're selling the time. So if something you see the prevailing price is let's say $10, but you can only sell at 9, then the spread is $1. So because of that, it's another cost that you have to pay, which is what the bid-ask spread is there to show. But the main thing there is the expense ratio. I'll talk about that. I can show you a live case later. Okay, so liquidity is very important because when you want to get out, you want to get out as close to the price you see on the screen. Okay, so if it's very illiquid, the spreads will be wider, and because it is wider, you will not realize the exact cost. Okay, so that's a bit of an inefficiency if, for example, you're in a very illiquid asset. So for example, if let's say you have a very liquid ETF here, which you can buy and sell anytime, the average spread between buy and sell is 0.01, very, very low, very, very efficient. Whereas this one over here, PRME, very, very big spread, 1.2%. So whenever you want to sell, you have to take a 1.2% discount. And that is something that is a little bit more expensive than over here, okay? So tracking error, what is tracking error? Tracking error is basically how closely can the ETF follow the index or the asset class that it claims to follow. So no one has a monopoly on what assets that they can follow. It's a free market. Anyone can issue an ETF to follow any type of asset class. As long as you have a theme, as long as you have an idea, you can just file and you can launch an ETF. So you can see here that there's many ETFs that follow the S&P 500, but only this one, SPY, follows it very, very closely. So the slippage or the tracking error, it's only 0.25%. Whereas over here, this SP5, I haven't even seen this in real life, but the tracking error is 3%. So for example, if the index goes up 1%, it could go up 4%, or it can go down 3%, or anywhere in between. So up and the plus minus of whatever the index is doing is plus minus 3%. So it's very, very loose. You definitely don't want that. You want something that has very, very little tracking error. Okay. So yeah, I basically just said this, right? So tracking error is basically like an additional cost to you, and it makes your construction of the portfolio very difficult. Okay, so just to reiterate, you want something that's simple to use, you want something that's cheap, liquid, and the tracking error is low. Okay, so now let's look at when to change the ETFs in your portfolio. Let's say you buy 5 ETFs. You shouldn't just stick with these ETFs forever. You should actually look to change these ETFs according to a certain logic. If you don't change it forever, basically you will go up and down along with these ETFs, because the ETFs are passive. The ETFs are meant to follow the index or the asset class. So if you have 5 of these static ETFs, they will just follow the index or the asset class wherever they go. And one way of making sure you gain more money, you make more money with using ETFs as well, is you can change the composition of these ETFs from time to time. Not to say every day, but maybe every year or following a specific logic. So one very easy, example I use is that when it's raining outside, you want an umbrella, and when it's snowing outside, you want a thick jacket. If it's hot outside, then you want a singlet. So that's the same as these ETFs as well. You can change your ETFs in your portfolio to suit the right environment. So this environment I'm talking about is the economic environment, right? So if you just think about, you simplify things, if you just think about 2 different asset classes over here, you have equities and you have bonds. You can see in good times where growth is very high, say GDP is very high, industrial production is very high, and inflation is low, equities tend to do very well. Bonds, on the other hand, very flat. But you definitely want bonds in a recession, because regardless of how well your business is doing, the business still needs to pay back the bondholders. So they need to pay you a certain amount, and because of that, bonds tend to do very well. And the S&P, which represents stocks, doesn't do very well, because naturally stock prices don't do well in a recession. Okay, in a period of stagflation or inflationary growth, you want combination of both, but depending on the situation, you want a little bit more of something. Maybe in inflationary growth, you want more equities. In stagflation, you want a little bit more bonds. Okay, so just to be clear, I just want to show you that whatever ETFs you buy, you don't have to keep them forever, right? They're not like your kids, they're not like your husband or wife. You don't have to keep them forever. You can change them, and how you change them depends on your view of the economy, the real economy, right? It doesn't have to be like something where you change it every day, okay? Because then you will incur more fees and then make it not worth it overall. Okay, so I just want to show you something very quickly, and then I'll come back to the slides. Okay, so I think you can see this. So basically, this website is a very useful resource for you guys. It's called ETF.com. ETF.com is a database of all the major ETFs in the world. So it can give you a lot of standardized information for you to see what ETFs you want to choose from, and then you can do your comparison. So for example, IVV represents the S&P 500. It shows you other ETFs that also replicate the S&P 500, so that you can see there's others. There's SPY, VOO, DIA, whatever, all these, right? You can see all the different stuff. And it describes it a bit for you, right? So it tracks a market cap with the index of US large and mid-cap stocks selected by S&P index. Okay, then we go over here to the data. You can see expense ratio is very low, 0.03. You can see how big it is. You can see that it's, let's just say, 300 billion US dollars. And if you times 4, you get basically 1.2 trillion ringgit. And 1.2 trillion ringgit is bigger than the entire Bursa Malaysia market cap altogether. So you can see that these dinosaur super large whale ETFs are things that you can just buy and sell. Even if you have 100 million ringgit, you can go and buy ETF, go in and out, no problem. Okay, the volume, very liquid. This amount is bought and sold every day, and then the spread is very efficient. You can't even see in 2 decimal points. Okay, what else can you see that's interesting? You can see the returns. This is the 1-year returns. You can see in 1 year it has done 32%, but that is just a short period of time, especially since it's a 1-year anniversary from when the from March last year when things do very well. So you must look at a long-term horizon. If you look at 5 years, okay, 5 years it does 16%, still very good. 10 years, 14%, still very good. Okay, that's returns. Naturally, it's only in the US, right? So 100% US. This one's interesting, sectors, because this shows that what are the most valuable sectors in the S&P 500. See tech, consumer cyclicals, financials, the banks, all that. Yeah. And then you get to see what are the top holdings. You can see Apple, Microsoft, Amazon, Facebook, Berkshire Hathaway, Tesla. If you look at these holdings over here, you can go into a lot of detail as to how much they are worth within the specific ETF. Okay, so let's say here you say Visa, P&G, Home Depot, all around 1% holdings, but there's 500, right? So there are 500 different things. So all of them can be viewed here. You can also see the tracking error. Here's the tracking error, very close, 0.03. Okay, and what else is interesting? Yeah, I think that's pretty much it. There's other more in-depth things you can see, but I won't go into detail. Another one, just for flavor's sake, this one is also something we have in our ETF portfolio now, is China Internet Sector ETF. So this one is issued by Crane Shares. The one earlier was issued by iShares, which is BlackRock's ETF brand. This one is by Crane Shares, also a very large company. You can see that it can compare this to other types of ETFs as well. And it shows here, tracks a foreign equity index composed of overseas listed Chinese internet companies, right? Because a lot of Chinese companies list on the US, and because not everyone can just go into the Chinese market and buy an ETF, it's very useful to actually get Chinese ETF listed in the US. So let's see. Okay, this one is the expense ratio a little bit more expensive because getting these shares costs a lot of money, because these are not the largest stocks in the world. 0.76, still quite cheap, but overall more expensive than the IVV. Assets under management, definitely smaller, but still quite big, 4.5 billion US dollars. Number of holdings, 42 different Chinese companies. Okay, you can see the performance. Okay, over 5 years it's done 16%. Over 3 years, 3.2%. So you can see when you're talking about China market, when it goes up, it does very well, and goes down a lot as well. It's quite volatile. So these are the main holdings. See all the familiar names, right? But if you go into the top 10 holdings, then you can see other smaller companies that probably haven't heard of before, but maybe you've seen them. Okay, so that's what I wanted to share. Let me just go back to my slides. Okay, so just to recap, right? Does investing always mean you should pick stocks, right? Not always, because you can always use ETFs. You should focus on asset allocation. How much percentage do you want to put towards what ETF to target a specific risk level? So let's just say you are very aggressive and you determine, let's say you want to put 80% into equities. So 80% into equities means that you can buy maybe 3 or 4 different ETFs, right? So you can pick Asia exposure, US exposure, maybe some sector exposure if you want. And then the 20% bonds one, you can just choose one US bonds or global bonds, okay? To use ETFs because they're very simple to understand, very cheap, very liquid. And you can change the composition of the ETFs by looking at the economy and deciding, okay, we are in a recession, let's just change the composition. Don't need to hold on to your ETFs as they go up and as they go down and as the economic cycles change, okay? So that's our time. Let's just, before we go into Q&A, just talk about StashAway a little bit for those of you who are new to us. Basically, we now manage over $1 billion US in people's money, people's wealth. back in 2016, we started off our company wanting to manage people's wealth for the long term, and we've managed to achieve a very significant milestone in this 1 billion assets under management. But we are always growing, and we want to work harder to continue to attract more of people's wealth. Okay, we are licensed by the Securities Commission, and our fees are very low. Our fees are 0.8% per annum. So we are a fund manager, like the let's say your other traditional unit trusts. They are fund manager as well. But the main difference between them and us is that they actively try and beat the market, whereas we get passive ETFs and we charge very low fees, which is why you can see this 0.8% versus the 7% that unit trusts pay. Okay, so other than that, this is how the app looks like. It's very, very simple to use. And basically, if you just download the app and submit your documents, you can start investing, and you can see here on the home screen some articles, how much you've invested. You can see you can make different portfolios, one high risk, one low risk. You can also click inside and see how much it's grown. You can also see inside each portfolio what is your asset allocation, and also what ETFs we have chosen on your behalf, right? So because of that, it's a very, very transparent app, very user-friendly as well. Okay, here are our returns. This is per annum, right? So per annum, we've done anywhere between 3.5% all the way up to 17%. So depending on what risk level you want, you can just choose between 12 different portfolios. I only show here 6 because of limited space, but you can choose between 12 different portfolios, and with that, you can expect the returns, the risk and return, to be proportionate in this way. Okay. Another service we have is StashAway Simple. So StashAway Simple is slightly different to our ETF portfolios because this is mainly for your spare cash. You don't really want to invest for the long term. This is for your emergency funds or whatever spare cash we have. StashAway Simple now offers a rate of 2.4%, and unlike FDs where you have to lock up your money, basically you can take your money out anytime and still earn the interest that's owed to you. So if you invest for 6 months, you can get 1.2%. If you invest for a full year, it's 2.4%. Okay. So for SpeedHome users, we have a promo as well. The last time we spoke, we also gave out this promo. So for any users of SpeedHome, or if you're attending this today, you can just take a screenshot of this, go to your research, and then when you want to sign up, you can just click on this mini URL over here. Just key in this mini URL, bit.ly/StashAway SpeedHome. And if you sign up this way, you can you can enjoy our service at half price. So basically, normally we charge 0.8%, right? So normally with this, you will get 0.4%, sorry, 0.4% for 6 months. Okay, so it's a pretty good offer if you want to get started. So just take a screenshot of this and use it later. Okay, it doesn't expire, so take your time, research, and when you're ready, just click on this link over here. Okay, I'm gonna stop sharing and go back to the main screen. Guys, if you want to come back online and share something yourself, you can go through Q&A as well.
Already, the questions already is like our audience is very proactive. They already share like 7 questions. So guys, please take these opportunities, because I think that Wai Ken is a very busy man, and then really appreciate that he just allocated his time and then to share some insight about how to diversify your wealth with ETF. So please take this opportunity, ask as many questions as you can. So first questions, Wai Ken. Now the US stock is like in an all-time high. He wants to know like the risk on invest on the base the US stock-based ETF. Well, the risk is very high.
Okay, so firstly, there's 2 things. If you look at any long-term track record of the US market, you will see that the index will have appreciated, right? I show you guys IVV just now. It goes up around 11 to 15% per annum. So let me ask you a reverse question. If let's say I ask you in March last year when the market was at its lowest, do you want to go in or not? Will the risk be very low? No, right? This doesn't mean that the market is low, it means the risk is low. Market's high, risk is high. There are ways to reduce your risk. So the first thing is to invest for long term. Don't just think that if you go in now when the market is a certain, say, all-time high, it will continue to go up forever. Of course, it may go down and go up. As long as you hold on for long term, you'll be fine. And the second thing is to dollar cost average, right? So dollar cost average means that if you invest, let's just say 1,000 every month, regardless of where the market is, eventually, as long as the market is up in the long term, you would have made money. So you can go in at a cost price. Let's say the index is at 1,000. So you go in at 1,000, go in at 900, and you go in at 1,1, and you go in at 1,000 again. As long as the market is up in the long term and you dollar cost average, you'll be fine. So all those who invest in March and April last year are all very happy because they already make money. But I will say that, you know, even in this situation now, if you're cautious, you can put a little bit and then just dollar cost average.
Just a quick feedback. One of my friends, they invest that time by using StashAway. It's got a very handsome returns, and then make me to use StashAway also.
Yeah,
Now I'm also a StashAway user actually. By the way.
Oh, good.
Yeah. So continue. Second question. Seeing this is very similar. It's like now it's U.S. inflations will it affect the ETF and stock because about the federal's interest rate. So this is also some things that seems that this Raymond is quite sophisticated investors, right? Yeah.
Sure. I mean, it's the news of inflation is widespread. So a lot of people are focusing now on inflation. Inflation is a very normal thing, right? It's just that it's not that inflation itself will necessarily affect your ETFs and your investments. It's more that what will the central bank do? So naturally, the central bank, if they want to rein in inflation, they will raise interest rates so that they can incentivize people to put more money in savings accounts or put money towards bonds and have less money circulating and buying up things in the open economy, so the inflation reduces, right? So the Fed chair has said time and time again that he will let inflation run, doesn't want to raise interest rates yet. So you can see who thinks that the interest rates will go up, because certain economists will forecast that the central bank will definitely not tell you ahead of time, but it is telling you through its press conference and all that. So when they say, you know, they might raise rates next year or whatever, basically it's a game of chicken, right? Who blinks first? And if inflation continues to go up very strongly, interest rates will definitely go up at some point, maybe not this year, but at some point. And because of that, then stocks would go down. I wouldn't say it goes down because the companies suddenly all don't do well. It's just that when people do valuation on stocks, the denominator, the number underneath, to discount the stocks to today's prices, the present value, they use the interest rate. So naturally, if your interest rate is 0.5 and you discount it back, then it's a certain number. But if let's say it goes to 2%, it won't go to 2, like just using the number. Let's say it goes to 2, then you discount it back, then it's a much lower number. So because of that, stocks will go down because the valuation on stocks will go down. So that's why when I show you the economic cycles, it's important to change from time to time. So when inflation goes up, you should look towards things like gold, look towards things that do well in an inflationary environment, like let's say oil, Aussie equities, because they are exporting commodities, right? So all these will do well. Let's say you get into consumer discretionary like Starbucks and Nike and all those kind of things, and that way you can benefit from this higher inflation.
Okay, cool. So second, it's just someone is asking how can he invest on the StashAway. Do you see the link that why can't just share on the in our chat? Just click on the link and then you'll get half Okay, you get half of the percentage of the management fee, 50% discount of the management fee. Yeah, then you can start like using. But better you do your own study. I think like StashAway is very clear. They put it their terms and conditions, everything's very clear. You can just start by research. Okay, continue. Wee Ning, she's asking same quite similar thing. I think we can skip these questions because it's quite similar with the second questions. So number 5, how much is the transactions fee of the ETF? So normally it's like traditional ETF is charged how much and StashAway charge how much?
So I would say that if you just want to buy ETFs yourself, you can use a local broker or a foreign broker, because a local
Okay.
broker will connect to overseas markets, and then let's say they charge 0.5%. That's what it costs to actually buy the ETF. And then you look at the expense ratio to do that, right? To get the cost expense ratio of, let's say, 0.7 or 0.03, whatever it is. That is the fee of the ETF. The transaction fee is what the broker, your particular broker, charges. Okay, so it depends.
Okay. So you see, suddenly the questions is bombing in. So questions are number 7. Which industry we can look? Yeah. Sorry. Where can I buy ETF? Any recommendations?
Okay, there's you can buy through. I would say try and buy the ETFs in the US, and because of that, it's just a bigger supermarket, and you can choose any foreign broker or local broker that you want, right? Whether it's your Rakuten, or whether it's your Maybank, whatever it is. As long as they have access to the US market, they'll likely have access to those ETFs. So it's really up to you.
Cool. Mr. Liu Yok is asking, are the platform using AI algo to invest?
I would say we don't have an AI, because AI is a very sophisticated tech, right? And it's like, who can explain really AI to you and machine learning and all? It's like probably selling something to you. I don't really want to say that we use AI, and the applications of AI so far we haven't applied it to investing. What we have is, if you look on our website, is this thing called ERA, or ERAA, which is economic regime based asset allocation. And ERA is a systematic way of investing. And systematic way of investing is basically the system will take in economic data to identify where we are in the economic cycle, and based on that, we will have a asset allocation already set for that economic environment. So let's say we move into from not now good times, we move into recession. The data coming in will be very bad, right? So the bad data will result in an asset allocation that will look like more conservative. Okay, so because of that, we will not say it's using AI, but it's an algo, if you want to call that, but it's a systematic way of investing.
Okay, so continue. The next question is soon on. Is it when the StashAway selling from term insurance in Malaysia, selling term insurance in Malaysia?
Not yet.
StashAway selling?
Yeah, so in Singapore, we started selling term insurance because we have it's an industry-wide saying that you should actually look to buy term and invest the rest. So if you want life insurance and term insurance to get basic coverage in case you pass away while you still have many dependents, it's good to get term insurance. So let's say you pass when you're 40 years old and the insurance payout is 1 million, at least they are taken care of. We really don't like ILPs, investment linked products, for a variety of reasons, but this is the reason why in Singapore we chose to partner with Prudential to issue term insurance, because if you buy a simple term insurance and you invest in StashAway, you are buying term and you're investing the rest. So that's why we do it. In Malaysia, we don't hold your breath. Just go out there and buy first, because we need to work with insurance provider and that is very, very complicated. So not anytime soon, I would say.
Cool. So any thoughts on US economy recessions anytime soon be given? Wow, very long questions. giving Biden proposed another 6 trillion of money printing with no gold backing.
Yeah, so I won't say we will go into a US recession because what you see the US government is trying to do here is trying to balance their economic growth. And because the private sector is not really being so productive because it's just coming out of a recession itself, the government itself is trying to print a lot of money so it can spend a lot of money on things like clean energy, infrastructure, and all that to spur economic growth. So I think that is not so much a indication that we'll go through a economic recession, but I do think there's a indication that the value or the strength of the US dollar will decrease a little bit. So there's I forget already how many trillions of US dollars is out there, but 6 trillion is a relatively controlled number. It's not like 60 trillion, 600 trillion, right? So yeah, 6 trillion is RM, right? So if you divide by 4, it's like 1 trillion, 2 trillion, it's like not that much. So yeah, so it's not that much. So I would say that the government is doing what it needs to keep its economy afloat. But because you cannot simply print money and not have the currency be devalued, you can see it as some temporary US weakness, right? But it's all relative to ringgit as well. So if you have ringgit and ringgit for whatever reason, like Malaysia, maybe we also print money, maybe our economy doesn't do as well. The supply and demand dynamic will depend on how well we do in relation to each other. So you'll see, our ringgit 4.15 go back to 4.11, right? Like it'll just fluctuate in that range. It doesn't mean that, US dollar print a lot of money, for sure it will go to 3.8 because ringgit will be stronger, right? So it depends on the supply and demand and a lot of things. So, wow, sorry about that. Wind very strong, rain very strong.
Yeah. Okay, sounds like a very, what do you call that, like the weather right now is like very fit to the current situations. strong headwind.
I would say it's strong headwind. I mean, maybe in Malaysia, but like globally, things are doing very well. I mean, I see all my friends in Europe, like normal life, US, all normal life already.
Yeah,
it's just Malaysia. It's just like, everyone's stuck at home.
Yeah.
What to
Only
do?
Malaysia. What to do? Okay, next questions. He's asking, your competitor, not competitor, just a different platform. Fund Supermarts, like what's the difference between investing in ETF through Fund Supermart or StashAway?
I don't know what Fund Supermart charges, but I would say it's basically a difference in how you choose to invest. So in Fund Supermart, you can choose what ETFs you want. Whereas with StashAway, we create our own portfolios of ETFs. So while you cannot choose what portfolios will be while we cannot choose what you cannot choose what ETFs we use. If you trust us to make the right decision, then you can use us. If you let's say you have a very strong view that you want a particular ETF, then you can go through anyone, right? Use FundSmart, use a broker, whatever. But StashAway, we already curate the ETFs for you, we select for you. So if you want to use our service, that's the way it goes.
Yeah.
Right. So there's the difference. It's the difference between doing more homework or outsourcing a service, right? So it's really up to you.
Yep, and just share.
But I don't know the cost actually of FundSmart.
Correct. Just share experience on the StashAway. So like you invest when you invest via StashAway, it's not all your money, the money that you invest, all allocated to ETF, but also they will depends on your risk and your target, and then you will invest in the different underlying assets, so such as bond, gold, these kind of different things. So this is the difference of StashAway. And then so far right now, I already invest 3 months. I'm quite happy.
Oh, good. 3 months is relatively short period of time. So just keep it going. I think this year there will be a lot more. There will be some changes to the portfolio, which will make very soon. So you will see, specifically because of there's inflation that's coming up and all that. So I'll just say, at least invest through the cycle. Don't just say, 1 month no result. Okay, no good, right? So give it some time.
Definitely agree. Because while I'm investing in StashAway, I look for a long term and also a safer asset allocations. It's not like there's some things that I hope it will get me a 20%, 35% just within 1 or 2 months. But in the long term wise, like yeah, some things that you put the money there, you can sleep well. So yeah, anyone else, right? If no one asking questions, okay, we will take another 2 questions. We will take another 2 to 3 questions. So friends from Facebook, Twitter, Instagram, YouTube. So please take this opportunity and ask the questions that you want to know more about ETF or StashAway services. So please just type your questions here, or yeah, this is not an opportunity that like we easily to get. Yeah. So, but anyway, Wai Ken, so since like no one asked question, I would like to take this opportunity. So I want to ask you another question is, yeah, just now you mentioned, right, like Europe and US market, they're getting better, but seems like looking back to Asia, it's like seems the COVID issues still haven't resolved yet. So especially some semiconductors producing companies such as like Taiwan or Korea, this kind of area. So will you see like the Asia market will get continually get haunted by this COVID issues?
I would say if you look at the Asia market, a lot of the weightage of Asia is mostly in China. So if you look at some major economies like China, Hong Kong, Japan, and see how they're doing, Taiwan, right? See how they're doing, and then that will explain a large part of how how Asia is doing. I would say actually the shortage in semiconductors is a good thing for semiconductor makers because it puts a premium on the product and then basically gives them a chance to expand their production and make more money that way, right? So like let's say the pandemic was very good for Top Glove, they definitely the average share price, not average unit price of a glove goes up, and also the quantity of the glove goes up. So I would say that is good for long term, for semiconductor companies. And I would say that a big part of China is already coming up, and I'm actually still quite supportive of the Chinese government's move to break up or to limit the big companies in China, the big tech companies, because long term the tech industry is still very vibrant, and if you have more competition, it'll be good for users, and you will introduce more innovative players, not just a few big players like in the US, which is why they are trying to limit how big all this Tencent and Alibaba will grow. And then China also wants to have its own semiconductor supply and its own like 5G technology. For example, even Huawei is coming up with its own car now. So I think all these things are things to be very excited about. And I think with Asia, it's just about getting some exposure to it, because you don't know when Asia will post good GDP, good returns compared to the US. And you don't know who will win if US goes against China and has another trade war. So better to just diversify and have positions on both sides.
I see. Okay, cool. This is a very long question. This is a StashAway users. So yeah, and then he invests in Malaysia and Singapore market both. So with different portfolios in different currency. GBP and USD. So what is the mechanism deciding this? Can the company platform provide an overview of the overall investments?
Yeah, so I would say that if you invest both in Singapore and Malaysia, actually the both US dollar portfolios are exactly the same. Okay, let me just reiterate that there's no difference between the Malaysia and Singapore portfolio if they are invested in USD. Okay, it's just that in Malaysia, for capital control reasons, Bank Negara wants to limit certain investors from investing in certain ways. In Malaysia itself, we have two portfolios. We have two parallel sets of portfolios. One in USD, which is exactly the same as Singapore. And then we have one in in GBP, which is in the London Stock Exchange.
Yeah.
So this British pounds one is mainly because when you onboard that time, we ask you about your borrowings. I don't know whether you remember. When we ask you about your loan, we ask you about your car loan. Based on the number of borrowings that you have, Bank Negara limits you to invest overseas in a certain way. So because of this limitation, we structured one set of portfolios for people with borrowings in the UK. And then for everyone else, the USD one is exactly the same as Singapore. So the mechanism to decide this is basically you declare on our platform what is your situation, right? Just be truthful. And in terms of risk return, of course, both of them, we target the same amount of risk. Both of them, we have 12 portfolios, we have 6.5 risk all the way up to 36% risk. Long term, their returns will be the same. But in the medium term or short term, their returns may be different because we have different ETFs in the US and different ETFs in the UK because they are not the same markets, and we chose the best ETFs in those markets to form portfolios that we have for you. So no need to think so much like there's some conspiracy or whatever. Basically, we have some regulation we have to go by.
Yeah.
So we try our best in that situation, and whatever you get, it's whatever you get, right? Why we are not like, oh, Malaysia only use GBP. Actually, a lot of people in Malaysia use the USD one as well, more than the GBP one. It's just that because you have loans, you qualify for the GBP ones.
Yeah.
And then the USD one is the same one we have in Singapore. It's capital controls.
Okay. So I don't know. There's these two questions. One question is like asking quite weird, but I still try to address here. So what's the charges of ETF if buying 1 billion USD?
I don't know how to answer. When you have 1 billion USD, please go and enjoy your life.
Yeah, if you got 1 billion USD already, I think
it should be the same. I mean, like it's a bit of a silly question.
You can start your own family office.
Family office.
You can start your family office and then to be another tiger fund or something. Okay, what?
Yeah. Sorry, I think that question is a bit.
Yeah. I think it's like typo or something. 1 million or something. I don't know. But
it should be the same. Even if it's 1 million, right? You invest through a brokerage platform, it should be the same.
Can I start a family office if I got 1 million USD?
Not enough.
I know it. Okay, come back. The last question. Sorry, the last question. Will Malaysia benefit? I think it type win in the trade war, but I think the right phrase probably is it benefit lah. How if US and that got the trade war?
Okay. Well, when I saw that, I thought it was like, will Malaysia win the trade war? I'm like, I didn't realize we were in a trade war.
We are not. Yeah.
But even if we are, I hope we don't. We don't, and I don't know. But I think it does benefit us because largely when you have tariffs imposed on Chinese exports, we will look at ways to companies will look at ways to buy from other countries outside of the US, right? So Malaysia is definitely one of it as well, especially in the furniture industry, whatever exports we do, right? So let's say we have rubber gloves or whatever exports, we will do well. So I would say slight net benefit, but trade war is usually not good for a lot of parties. Okay, guys, it's almost 4:30. I have another thing I have to run to.
I think like this is the last questions. And thank you, Wai Ken. Thank you for your time for sharing such a very interesting and insightful knowledge to our users and SPEEDHOME users. So thank you so much. And those who haven't haven't logged into the link, and then you haven't used StashAway before, you log into the StashAway, the referral link, not referral link, sorry, the promote link. So the StashAway promote link, just log in, register, and become StashAway user. Thank you, Wai Ken. Have a great day ahead.